Welcome back, everybody. We are back with another video series episode. This is Why We Invest, a long-term view on markets and investing. I've been a bit on a video kick lately, hence more videos and less blogging, which it kind of ebbs and flows. So I hope you all are enjoying these videos. Again, if you have any feedback for me, we've tested a few platforms and whatnot, but this is essentially an episode where I zoom out, and I'm not getting into the weeds on what's going on in the economy or what's going on in markets. This is more of a long-term, evidence-based presentation on why we invest. And sometimes I think it can get lost because we're all caught up in the moment. We're all caught up in the forest, and sometimes you can't see the big picture. So I hope you enjoy this. Some of these slides I might have referenced in the past, but these are newly updated. I'm recording this on Tuesday, the 5th of December. Let's get into it. All right, so this is a graph of the S&P since 1928. And I know there's no shortage of things to worry about today, and sometimes that can feel very unique. But there's an old saying that a crisis in the moment today feels like the worst thing ever. In hindsight, a lot of these episodes are an obvious opportunity, and that's called hindsight bias. But we're inundated with global news. No longer are we getting local community news on the softball tournament down the street. If there's a problem in the world, we are going to hear about it, and it does leak into how people feel about the world, the economy, their investment portfolios. So this is just a reminder that since the beginning of time, essentially, there's always something to worry about. And you can go on down the list. This starts again in 1928 all the way through last Friday's close. And you can see, despite all of these geopolitical, macroeconomic, random events, markets tend to want to go up. Now, there's, of course, dips, which is a natural part of investing. But in general, throughout history, markets tend to want to go up. All right, this is one of my favorite graphs. This is the S&P 500 total return. Percent of times returns have been positive over various time frames, again, since 1928. So this is about 95 years of data. This is pretty strong. And over the short term, so this starts at 1 month, 6th month, 1 year, all the way up to 20 years. So how this would read is for any 6-month period over the past 95 years, there's a 70-ish% chance S&P returns would be positive, okay, which means there's roughly a 30% chance that you could lose money over any 6-month period. And you'll notice as we move to the right, as our time horizon expands, the percentage gets steadily higher, okay? And the magic number here is over any 15-year period or 16-year period, there's almost a 100% chance that you're going to achieve a positive return investing in the S&P 500 or investing in U.S. large cap stocks. So while there could be short-term noise in markets and, it could feel like a very scary time to invest, contrary to what people think about equities, the longer you own them, inherently less risky they become, and the data backs that up. Now, I know a lot of people like cash today, and as we're going to see in our next graph, cash over the long term is more risky than people think, although it does provide a nice safe haven in the short term, and it's nice that cash is now yielding something, 4 to 5%. Okay, so let's look at the buying power of $1,000 in cash stuffed under your mattress since the end of World War II. So this is purchasing power, adjusted for inflation, essentially, on what $1,000 can buy you over time. And you can see 1945 to 2022, let's call it, $1,000 buys about 90% less than it did in 1945. So a person in 1945 with $1,000 can buy much more goods and services. Someone with $1,000 today buys much less goods and services. On the flip side, a lot of investors have been worried about inflation over the past 18 months or so. Stocks, the S&P 500, are inflation's kryptonite. So if you're worried about inflation, there's a couple of really good inflation hedges. At the top of that list are stocks. So this essentially takes that same $1,000 and invests it over the post-World War II period and you're left with roughly $3.5 million, a return of over 20,000%. So again, cash, although it's safe in the short term, can be more risky in the long term. Equities, as we saw from our last chart and this chart, can be risky in the short term and quote unquote safer in the long term. Now, I know a lot of retirees might be saying, Nick, I don't have 20 years to invest. That's fine. I would say build a portfolio that reflects the way that you feel about risk. So that doesn't mean 100% S&P 500. It might be 40% S&P 500 and a mix of other safer asset classes. So find the portfolio that fits your cash flow needs, fits your risk profile, and think of that as your long-term portfolio. Cash is fine if you want some dry powder, if you have an expense coming up in the short term, if you have a short-term cash need, but cash is not necessarily a long-term investment strategy. All right. So many people are worried about timing. Like, Nick, I have some cash. I'd like to get fully invested. And they end up agonizing over when that optimal time to get invested is. And look, that's a valid question. And of course, the popular way to smooth that out is to dollar cost average, is to invest in phases to help smooth out some of the short-term market swings. However, what this is assuming the investor got invested at market peaks. So right before the 1987 crash, right before the dot-com bust in 2000, right before the financial crisis in 2007, right before the COVID sell-off of 2020. Okay, so we're assuming someone gets fully invested in stocks and bonds right at the peak, and we're tracking performance going forward. Okay, performance since 1987, since 2000, since 2007, since 2020. And even an investor with unlucky, horrible timing has achieved an annualized return of 9.9% in equities investing at the top in 1987, about 5.5% for bonds. 6.5% if you invested at the peak of the dot-com bubble, roughly 4% for bonds. If you invested right before the financial crisis in 2007 at the peak, you're still achieving a return of almost 9% a year for the S&P. And then the same thing with the COVID sell-off. Bonds, of course, have been hit pretty hard by this outsized inflation, aggressive Fed. But you would expect this to mean revert, to go back to historical norms. And I've written a lot and spoke a lot about starting yield as a great precursor for future bond returns. Starting yields on the Barclays Aggregate Bond Index, which is a snapshot of the U.S. bond market, right around 4%. So that's a pretty good expectation going forward for future bond returns. Okay, so this looks at the S&P 500 again since December 1927 all the way up to where we're currently at. So the blue line is the S&P. These red lines are bear markets. So the vertical lines you see here are bear markets. The green lines are bull markets. And for those of you that need a refresher, a bear market is a market sell-off of over 20%. A bull market is a market rise of over 20%. And there's a couple takeaways here. One is bear markets last much shorter, over a much shorter time frame than bull markets. So since 1927, the average bear market sees a loss of about 35%, and it lasts about 286 days. You can see as you go through history, some of these bear markets are rather shallow or brief, and some are quite lengthy, over 600 days here, back in the mid-70s and early 80s. The tech bubble lasted for about a year and a half. On the flip side, bull markets are much more intense on the upside, averaging about 114% gain, lasting for over 1,000 days, again, on average. So this is over 3 years, or about 3 years, that the typical bull market lasts. And you can see the one we just had from 2009 to 2020 lasted 4,000 days, over 10 years. And you can see that was rivaled only by the period of the late 80s to the tech bubble in early 2000. But the takeaway is, again, markets have a bias to the upside. You have to be careful for these market bears and the pessimistic investor. The world can only end once. So you have to be careful about hiding in a bunker and being overly conservative. And I've updated my beliefs on this. I think being a pessimist is the worst investment trait. I used to think it was FOMO, the fear of missing out, chasing performance, which is still not a very good asset, I can't even call it an asset, still not a very good attribute for an investor. But I'm convinced, and this backs it up, that being a pessimist is probably the most costly investment mistake people make. I'm on record saying politics and investing do not mix. I feel like this chart backs that up. We're getting into an election year next year, and I already preemptively wrote about S&P returns during election years, but I know the wave of questions and concerns are coming. And what this is $1,000 invested in the S&P 500 since Eisenhower was inaugurated in 1953. Okay, so returns for $1,000 only invested when a Republican is president. So $1,000 invested post 1953, only invested when a Republican is president, has grown to about $27,000. Okay, same $1,000 invested post 1953 only when a Democrat is invested or is in office. When a Democrat is president, has grown to about $52,000. Okay, you see that over here. 1,000 invested when the S&P since Eisenhower, 1953, Republican, Democrat. If you ignored all that and just invested across all presidents, you would have $1.4 million. Okay, so I'll say it again. Politics and investing do not mix. Think of it like an NBA game or an NBA season. From game to game, the referees might influence the outcome of a single game. But over the course of the season, players are going to determine outcomes. Their skill, how they play as a team, the coaching, the talent they have on their roster. That's going to ultimately determine how far they go and if they can win the title. Okay? The same thing applies to the global economy. Sure, the president who's sitting in the White House can have a short-term impact on policy, on taxes, on how the market moves. Call it over a period of a week, a month, even 6 months. But over the course of a full presidential cycle, a long-term investment horizon, the players are private business, corporations, consumers, global trade, geopolitics, interest rates, inflation. Those things matter much, much more than who's sitting in the White House. And in general, people praise a president way too much when things go well, and they pile on and berate a president when things don't go well. And presidents in general receive too much credit when things go well, and they get the short end of the stick when things don't go well. So again, market forces, big business, consumers, those are the players. The referees are who's sitting in the White House. I hope that makes sense. But in general, ignore all that. Ignore politics. It should not leak into your investment portfolio. That's a recipe for disaster. Okay, short and sweet. Again, this is why we invest. I wanted to do this to zoom out. This is the time of year where people are looking at their investment portfolio, thinking about making changes, and you're probably getting forecasts from Wall Street banks or your money manager, people predicting on what happens next. Let's zoom out and get centered up again and understand this is why we invest. I hope you enjoyed this. Thanks for watching. Thanks for listening. We'll see you next time.